Today we have on Gordon from Circle. Been doing quite a number of episodes recently on stablecoins, and so I'm fortunate enough to talk to all the important stablecoin people now, I guess. So today we have on Gordon, who's head of research at Circle. Is that the correct title, right? Head of research.
Chief economist and head of the research. I kind of wear two hats.
Yeah. Also, but you have I was noting this beforehand, you have quite an interesting background. You worked at the Federal Reserve and you worked at Uniswap. So you have quite a breadth of knowledge. So we're going to hit on a lot of topics. But yeah, maybe we can start with just a little bit of background and then we can dive in.
So yeah, you briefly mentioned my background. I think most of my career has been in finance. I've seen the most centralized type of finance in central banking at the US Federal Reserve Board in DC. I've also seen the most decentralized finance at Ellipsis Labs, led research and built up a research team there. And early on in my career, I actually started out as a fixed income trader for the Harvard Endowment. Ran a portfolio there and later on spun out a fund with my colleagues there. And that early career experience actually taught me quite a bit about just how markets behave and how intermediations work, which later on brought me to kind of wanting to always do deeper dives on how does intermediation actually work from a theoretical perspective. So I went to get a PhD in economics and wanted to understand how can we improve intermediation. So went to the central bank and worked on a number of market structure type of policy issues, also including lending tremendous amount of liquidity into the market, which later on I felt well, that's a very centralized way of addressing market concerns and kind of swing all the way to the other side of, let's see what DeFi has to offer. And I think now at Circle, I've been at Circle for 3.5 years roughly. It's truly the bridge between the two worlds, the TradFi world in which I used to work in and the DeFi world that I also been a part of. So glad to be here and happy to chat about any topics.
Yeah, that was great. Okay, so talk to me a little bit about your current day-to-day at Circle, what you actually do. I mean, you say chief economist, head of research. These are important sounding titles. What does that actually look like in practice? Obviously, Circle's soon or in the process of launching a layer 1, which we're going to talk a lot about. But yeah, over the past 3.5 years, what exactly do you do on a daily basis?
That's a good question. So if you think about what economists do generally, right, it is about one is understanding the world, understanding how overall society function from economic capital perspective, but also understanding how markets function. And economists in finance oftentimes focus on the markets and also designing markets. So in that vein of work, as the chief economist, I frequently interact with, for instance, central bankers, external policymakers, etc. Internally, I think it's equally a large number, a body of work related to how can we build the strongest, the most resilient, and the most credible and trusted and regulated stablecoin that's fiat-backed. It's not just putting dollar into a bank and calling a stablecoin. Rather, there's actually quite a bit of intricacies when it comes down to management of liquidity, management of capital, management of various type of risks. So I basically helped out the team in designing some of the key frameworks, for instance, around our capital ratio management, around our stress testing. So things that you would expect from a traditional, almost like a treasury management type of function, but more from a design angle of this is quite a new area, new space, and how do you best position the stablecoin to be the most liquid, the most redeemable, given that the liability is really different from any sort of traditional institutions because of the high volume, the high velocity of money that we're dealing with. And also just pontificate on the development of stablecoin, of on-chain finance, of Web3 more generally. So that's on the econ side. And today I'm actually recording from Dubai, where I'm attending and presenting at the World Economic Forum conference. So that's very much on the economist side. And on the head of research side, I am actually part of the engineering team. So I lead a small and mighty team of researchers, and I work very closely with our broader set of engineers. Also designing markets, figuring out some of the technical questions. Right now, as you alluded to, we are building Arc, which is a layer one blockchain. And there's quite a bit of design decisions around that that I'm involved with. And it's been quite fun.
What exactly did you see in DeFi that you thought was like a massive unlock? And the reason that I ask is because, you talked to Tolly from Solana, right? And he is adamant about, this idea that like we can make trading more equitable. We can truly make a market such that there aren't necessarily these people who have like outsized power. Then you talk to people in, I don't know, like the originally, kind of from the OG Ethereum, and their idea is this like highly decentralized DeFi. Like maybe it goes a little bit slower than Solana. From your like background, like what was the big, I guess, massive unlock to you with DeFi in general? And then if you want to parlay that into stablecoins, feel free. But if not, take it wherever you want.
Sure. Yeah. I think to me, DeFi means decentralization of balance sheet and decentralization of intermediation capacity, which is quite different. It's almost like an academic answer because I study these from an academic angle, but I also experienced it as a trader before of seeing how basically, wherever you are at institutional level, you're dealing with a set of a handful of broker dealers. Every time you're making trade, it is not just quoting a price, but it is actually moving of balance sheet risk from one counterparty to another. And specifically in the past, I worked on fixed income relative value type of trading, which means it is all these not really true arbitrage, but arbitrage of balance sheets. Sometimes you would call it balance sheets that are imposed because of regulatory reasons, or maybe it's a form of Reg Arb. But a lot of it actually came about after 2008 because there was a tightening of balance sheets of the banks due to the financial crisis. So all of a sudden, you have various types of spreads blowing out. These are like LIBOR versus OIS spreads, Fed fund versus Treasury spreads. All of those are indications of essentially intermediation failures. And I've also done academic works on this and also looked at this from a policy angle at the Federal Reserve. All of these intermediation failures actually are quite concerning. You think that traditional finance works, pretty well at an institutional level, but in fact, it's actually not the case. When you look at the treasury market, despite how large it is, the liquidity in the treasury market isn't that great for institutions. On a normal day, you get great liquidity, but when things go south, there's really lack of liquidity. And in 2020, I was at the Fed at the time, early around March 2020, during COVID. We rolled out, I think, got to be half a dozen at least of programs basically injecting liquidity in the market. And to me, that was just kind of I seen this in 2008, I seen this again in 2020. It was a wake up moment of, wow, the only way we can solve liquidity is to injecting more money into the system and doing massive amount of quantitative easing. But that's not a great solution because it has a lot of other consequences on asset prices, on society, on even inequality. Right? So that's actually when I actually truly started paying attention to DeFi. Uniswap actually, I was paying attention to stablecoin at the time because of Meta and Libra project, but also I was paying attention to what's going on in the DeFi space with AMMs because I truly viewed it as a way of, well, possibly you could decentralize the provision of liquidity, not from these centralized intermediaries that are quite concentrated and perhaps too large to fail. Rather, you could move those risks to the peripheries, to the end users, not necessarily end retail users, but asset managers and insurance companies and et cetera, that have the capacity to take on risk, that could provide liquidity into the market. And these are perhaps slower moving capital than usual, but they could actually provide enormous amount of liquidity when needed. Now, I think how stablecoin ties in, it's also quite interesting, right? If you think about, in a way, fiat-backed stablecoin is centralized, but in another way, it is a way of actually removing some of the too big to fail risks that we have with the existing banking system. So this is perhaps controversial, but I don't think the idea of stablecoin is new, that is in the last 10 years or so. But if you go back to the writings of, say, Irving Fisher and a whole bunch of economists, Milton Friedman as well, after the Great Depression, they wrote about this concept of full reserve money. Irving Fisher had a book called 100% Money, which is all about not using fractional reserve backing of banks to kind of commingle lending and payments, but instead to separate out the investment banking functions and the payment functions. I think stablecoin actually is the modern version of that, in that you are creating this full reserve 100% money, or at least attempting to create it. We're not there yet 100% because still today we rely on banks. But I think getting to that 100% money is actually quite valuable because you can reduce the too large to fail risk. You remove that level of leverage from the banking sector. And at the same time, you don't necessarily have to reduce the amount of credit provision, which I think is also a fascinating concept. So I was reading this 100% Money book recently, and there was one quote in there that just struck my mind, where Ivan Fisher actually mentioned that for the preservation of capitalism, 100% money is necessary someday.
Since I have an economist on, let's dive into this. It's going to end up sounding like one of these like Bitcoin Maxi episodes that I listen to, where there's just this, extreme disillusionment with like fractional reserve banking and all of this. But like, can you just kind of explain this at a high level? Maybe what is the issue with this notion of fractional reserve banking? And also, you're talking about like 100% money is like the final iteration of this, vision from a long time ago. What has allowed fractional reserve banking to work functionally for so long?
Well, basically, after every single financial crisis, 100% money gets brought back as a topic of discussion. Okay. And then it's like, well, in reality, you make more money as a bank if you can use other people's money to kind of make loans. So every time the lobbyists or the banks at the time kind of overrides it, and it's like, okay, we'll continue to do this with, of course, the government support and guarantee of either FDIC or bailout in the forms of large quantitative easing. But I think stablecoin is getting there.
Yeah, and explain why. Like, because it kind of, at least with regards to this kind of payment idea that you said, like you can maybe delineate between the two. And with a payment stablecoin, perhaps like you have this fully reserved, fully backed at all times. Is that kind of the notion?
So with especially a payment stablecoin that's fully fiat backed, the concept is you are separating the lending functions from the payment functions. So loans could go sour, but the payment system could still function. That is quite important for economy. It is also, I think, quite important for just continued operation of capitalism.
Yeah. I wanted to go back because you mentioned Uniswap and you said you kind of were quite interested in AMMs at the time. What was, and I may probe more, but what was your takeaway from AMMs, right? Like you said that, okay, we can shift risk perhaps in these markets and have liquidity provision when necessary. What was your kind of takeaway from AMMs? Like, could these solve this? And what do you think is the long run of AMMs perhaps?
I do think AMMs have a place in provision of liquidity. It is similar in a way currently as, in the equity market or in fixed income market, there are volatility swaps or variance swaps. Sometimes there are quarter variance swaps, which is kind of like a Uni V3 version. Right? Basically, it allows liquidity providers, oftentimes institutions, to sell vol into the market. So what does selling vol in the market means through a volatility swap or variance swap? It means whenever the market goes down, you're effectively buying the market. Whenever the market goes up, you're effectively selling the market. So that's what some of the large institutions, including Harvard, actually, we did some of that from a relative value perspective, buying one thing and versus selling another thing in terms of vol space. I think AMMs kind of democratize that a bit, but there's a lot more richness in the design space that perhaps someday you could actually have both the liquidity being provided through these sort of mechanisms that also caps the downside for the liquidity providers, so that you don't have 100% type of loss, as sometimes you do with, for instance, selling a variance swap and things going really south. So I think that's like a really powerful concept of getting the liquidity provision to be outside of just high frequency trading and being broader than the small set of institutions.
Do you find kind of like the XY equals K curve to be a massive unlock? Like, practically speaking, is this a real unlock for, I don't know, maybe you were talking about FX in the future, something like FX trading. It makes sense we would have much better FX, right, than what we currently have, at least from what I hear. I don't really engage in these markets, so I only hear this, but there seems to be a lot of liquidity fragmentation. There's a lot of like sort of unnecessary intermediation. Is this the type of thing in your mind that is like clearly, a novel application of the tech?
Absolutely. I don't think it's as simple as XY equals K, which is actually in econ lingo, it's a very specific utility curve called capitalized utility function with a coefficient of like 1 or something. So it's actually, there's a direct mapping to utility functions in econ. But this concept of AMM has been picked up by more regulated institutions. For instance, the Bank of International Settlement, which is kind of like a governing body of central banks, doing this project where they did this project of, I think it's Project Mariana, which is essentially applying an AMM model to FX, at least in the prototype or testing phase. And the idea is very simple, that there are kind of price agnostic liquidity provider treasury out there, either central banks holding FX portfolios or perhaps your global corporate treasurer. Maybe from the day-to-day perspective, you don't really care about how much exactly you hold of dollar versus sterling versus euro, but you generally just hold a set of fiat currencies. Perhaps you can provide that liquidity, the treasury portfolio, into the market, so then the FX market is more resilient. There's deeper liquidity as well. And AMMs and on-chain FX is something that we're looking into for ARK as well at Circle.
Okay, awesome. Well, then let's go back to Circle for a second. I've talked now to the guy from Tempo, Malesh, who was previously a mechanism.
He's also an economist, by the way.
Exactly. Yes. It seems like there's high demand for economists to design these mechanisms, which seems reasonable. So I talked to him. I talked to a guy from Agora recently, and then also I talked to kind of like a different version of a stablecoin. My point, though, is that I've been on a little bit of a stablecoin, tear right now, and I'm curious, just like broadly speaking, where you see USDC and Circle positioning itself. Like, this has got to be one of the most hyper competitive markets right now. Everybody wants a stablecoin. Everybody wants to kind of position themselves in a certain area. Like, you're now, one of the leads there. Like, where do you view yourself positioning, like payment stablecoin, some type of yield bearing in the future? Like, what is Circle's mission, at least at present?
Yeah, so stablecoin is as you noted, is our main business, right? So that is not changing soon, but ARK is a very interesting development. And I think part of the rationale for developing ARK comes from our operation of USDC over the past 7 years or so, in engaging with not just users in the DeFi space, in the crypto space, but also potential enterprises, potential institutions that want to adopt this technology. We came to realize there are a few shortcomings that time and time again, these questions get brought up. One is you have to, as an institution, an enterprise that's very much in the normie camp that haven't really dealt with crypto, they first had to even figure out, how do I send transactions? Well, I had to acquire this volatile token, either ETH or SOL. It's just user complexity. And by the way, it is really volatile in terms of gas fees sometimes. Even last week, the prices went up quite a bit for simple transfers. So we want to create an experience for users that is effectively, people don't have to think about what fee they're paying because the fee is denominated in USDC to start, and possibly we'll add other stablecoins. And the gas is also designed to be less volatile. We have a smoothing function that's a variation of the EIP 1559 based on exponential weight. So ways that we can smooth out the price fluctuations is quite important as one feature. The other feedback we've gotten include, well, it's great. I want to use this stablecoin for transactions, but I don't want all my transaction information to be shared broadly. I don't want my account to be broadcasted broadly. So we are also working on opting configurable privacy for ARK as well, so that other people could benefit from the convenience of stablecoin, but also the enterprises are typically have the transactions not fully revealed to the world, will continue to have some level of privacy, of course, with the right auto keys and etc. for regulators. And then the third thing is just finality, having fast speed, fast settlement that's guaranteed, deterministic. I think that's another thing that comes up once and over and over again, that people want to make sure that their transaction is final, both from a technical sense, but even more so on a legal sense of what does deterministic finality or finality mean from a legal perspective, which is something that we still had to figure out. But I think we're getting close with, at least with the design of ARK.
Okay, how is ARK? Like, give me a high level overview of the structure of ARK. Like, who are the validators? The gas is denominated in USDC. Explain like the design that at least is currently kind of being worked on.
Yeah, so currently we're figuring out a lot of the key pieces, but the user experience would be that they can transfer using USDC as gas, and it will be a seamless experience. They don't have to worry about holding another token and the volatilities associated with it, or having to figure out the accounting side of it as well. So it is a EVM compatible layer 1. The consensus engine is Malachite, which is it comes from the Tendermint consensus app, and we over the summer acquired a team called Informal Systems from Informal Systems that works on this consensus engine. That's also quite flexible, that allow a lot of rich design decisions that is to come. But overall, for ARK, we're trying to build not just a chain to be used for stablecoin finance or payments. We're trying to build essentially the infrastructure for bringing economic activities on chain. That is creating a economic OS of sort. Because again, we have quite a number of blockchains so far, but we think that so far the masses hasn't really adopted blockchain technology for usage, perhaps only for speculative trading use case and maybe some payment use cases. But the broader set of institutions have yet to adopt blockchain.
In terms of the actual, so it's a proof of stake system, I assume, right? It's layer 1. Okay.
How does that work? Starting out as a proof of authority. Initially, it's a set of validators that is essentially selected based on a quite a tough criteria of they had to be professional validators that have some history of validating and some level of guarantee in terms of the technical side. And then eventually, as we alluded to in our light paper, it will transition to a proof of stake, but still in a permission setting. So I think we'll always have a permission set of validators. And to me, that's actually quite important to assure that we have settlement finality, that transactions are going through known validators, not just any type of validators, perhaps state actors and perhaps those you don't want to be validators. And I think that is actually core to adoption for some type of institutions that care about the high level of following compliance and regulation, etc.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while building some of the most interesting products in the space. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. They're backed by Paradigm, Electric Capital, and Han Ventures. The founders, Eugene and Jerry, have experience at Citadel, Jane Street, and the Solana Core team. Since launching their order book DEX, Phoenix, they've done over $80 billion in trading volume by making on-chain order books competitive with centralized exchanges. They are also the team behind Gavel and SolFi. I would consider them the foremost experts in crypto market microstructure. The best part is Ellipsis is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer who wants to work on infrastructure that's already proving itself in the market, go to ellipsislabs.xyz. Okay, now back to the show. So what is at stake? Like, do you have, I don't know if you've disclosed this yet, but like, is there a like layer one token that will be at stake and then everything will be denominated in USDC? The reason I asked is because like with proof of authority, I guess the theory, this is one thing with somebody like Circle specifically or Tether specifically, I've long thought that if the native token is truly a fiat-backed stablecoin with reserves, I mean, I guess with USDT, like let's just say with reserves, but you could denominate the entire thing in dollars, right? As opposed to any other like blockchain, like Solana needs this native gas token, and you can abstract that away from the user. You can even abstract that away from validators, right? You could denominate the entire thing in dollars, but it actually needs a centralized fiat-backed stablecoin to denominate entirely in a stablecoin. So is that like sort of the premise here? You could actually just have validators truly be staking in dollars?
I think this goes back to like the original question you asked about decentralization, right? We do want to see some level of decentralization over time gradually, right? And that level of decentralization is probably needed to ensure that Arc network continues to function even if Circle is not around, even if in a resolution type of scenario. So some level of decentralization, I think, is healthy, but that's right now it's that might be a while away. And I think to your question about whether you could do everything in stablecoins, of course you can, but I think there's also equally valid arguments about making sure that there are different levels of securities, and proof of stake has been a way of providing some level of security for the chain and for different chains. But I just think that if you solely rely on proof of stake alone, not relying on permission validator set, that's a much more risky proposition, because essentially if you're trying to onboard the entire financial system and tokenize the entire financial system, there simply wouldn't be enough stake asset to back the financial system. It's as if you're trying to like back massive amount of tokenized assets with just a couple $100.
Right.
That's like
so like with
equivalence.
Yeah, with a permission validator set, you could in theory issue infinite amount of stables with some comparatively low level of economic security on the grounds that they're permission validators and they have signed some type of legal agreement that they're not going to be malicious. Like, is that kind of one argument you could make?
Well, certainly, I think there are many things you can make sure that validators have a high level of operation. And it's not just slashing that's the economic punishment, but rather you get to be kicked out of the validator set, or in some cases, maybe if you are truly pursuing something that's illegal, then you might actually be chased down by not Circle, but perhaps other folks. But I think I think the design choices are actually quite wide here, and we haven't figured out exactly how that transition will work later on. But initially, it's proof of authority.
The complete opposite side of this is, well, we can use Ethereum as an example. And of course, Circle has issued a tremendous amount of USDC on Circle, so I know you're fully aware of this kind of more permissionless validator set. But did you at Circle run into institutions and large actors, that may want to deploy on chain, but they simply are not willing to do it on something? I say deploy on chain, do whatever they want to do using, integrating with Circle or whatever on Ethereum, and they just simply cannot do that because they are, bound by some. And I guess, sorry to be a little bit wordy here, but like the other follow up I would say is that there's a lot of people who claim that like this is the future, and that this kind of like permissionless, completely open, free flowing money is going to win in the long run. But we do see a lot of stablecoin chains coming out, which at least causes some pause, right, in this notion of completely permissionless, everybody's decentralized, so on and so forth.
So yeah, so that's another area. This actually is heavily related to why I wear two hats, right? As the chief economist, I interact with policymakers all the time. And one of the issues that was brought up and actually written into the current guidance by the Basel Committee on Banking Supervision is the treatment of fully permissionless chains for capital ratio for banks. And the current guidance is if you're a bank and you deploy, you are holding assets on a fully permissionless chain with permissionless validators, then you basically have to hold $1 of equity for every dollar of asset that you hold on chain. For those type of assets, even stablecoins are deployed on permissionless chain, and that is quite prohibitive for any institutions to bear. And it comes down to this permissionless versus permission nature of the validator set. So, we talk to many banks and we talk to the regulators as well, and this is certainly an issue that has surfaced. And at least in my mind of designing ARC, we do have this in mind of how do we onboard the large banks that might be interested in deploying stablecoin or tokenized assets, but they want to do so in a way that is friendly from a regulation or capital angle. It's not that the Basel Committee for Banking Supervision has said you cannot do this. It's just the capital cost is prohibitively high right now for these banks that want to tokenize money or tokenize other sort of assets on chains. We'll see where eventually those guidance land in different jurisdictions, but this is certainly on our mind when we were designing ARC. How do we address those issues that's coming about from these regulatory conversations?
Do you see stablecoins being a winner take all, or do you think there's going to be a plethora of these? Everybody will have their own with some, slight distinctions or whatever. But I think there's kind of two sides of this, which is everybody's launching a stablecoin right now, right? So obviously they'll only be doing that if they thought that, there's long-term viability in theory, I guess. And then the other side of it is Tether and Circle to some extent have massive kind of economies of scale, and there's a lot of incentive to aggregate around a very small number of stablecoins. What is your kind of high level view on that?
Well, I think certainly we could have flourishing ecosystem of different stablecoins, especially stablecoins of different currencies, which is something that we haven't discussed much, right? But if you have tokenized assets that's currently denominated in different currencies, these assets could be, I don't know, Japanese bonds or, Brazilian equities. There's no way that you're only going to have dollar stablecoins. You got to have local fiat backed stablecoins supporting those, and you got to have tradings of stablecoins. But even dollar stablecoins, we currently have kind of A to Z list of stablecoins, and they have some variations in the features. I think it's also kind of what is actually considered stablecoin is the definitional thing that the Genius Bill or Genius Act now have spelled out what payment stablecoin is, and there are those who are trying to classify themselves as either synthetic dollar or tokenized assets, which is somewhat different, but also kind of related to stablecoin. And maybe those would have some niche markets. But yeah, you're right. There is some network effect. But also, I think it is actually quite costly today. If you're actually going to build a global scale stablecoin, it's easy to launch a stablecoin that has certain amount of liquidity that's localized to a certain market. But if you're going to have the banking connectivities, which Circle has the banking connectivities in every single major financial center, that is actually quite costly to build.
What is your experience as of late? And this is kind of topical, not so topical, but within the past month or so, a lot of these community banks have been, I say community banks, I'm not sure that's the exact word, but anyways, some of the smaller banks have been pushing back on stable coins. They've kind of even maybe reneged a bit on the initial agreement, which is they're realizing that stablecoins are like quite likely, at least in some capacity, to destroy a large part of their business, which is they're used to taking customer deposits, like chill deposits at some, extremely negligible interest, and then being able to do their fractional stuff in the background or whatever. What has your experience been dealing with these people? And it seems like they're on the wrong side of history, but they are trying to like kind of hold on to this. And yeah, what do you view going forward?
Well, I think community banks do have an important place in finance, right? I bank with a community bank as
Yeah,
part
me
of
too, me too.
my bank because they do understand the customers really well, and they do understand some of the customers' needs, and have kind of these soft lending, soft monitoring type of power in place, right? I just think overall, you're going to see a shift in terms of some of these traditional financial institutions becoming more like just a front end that is
Right.
plugged into perhaps stablecoin, perhaps a tokenized asset in the back end, right? If you look at how bank balance sheet today, even though most of them are not tokenized, but it's already changing quite a bit from maybe 20 years ago. It's no longer portfolio loans, rather it's securitized type of loans of sort. It is, MBS. It is even private credit, which is kind of funny to think about banks buying private credit. So that trend is going to continue, whether with stablecoin or without stablecoin, or with tokenization or without. But I think they can probably do it much more effectively and just focus on improving the customer relations, making sure that they're serving their user base the best, and they could still maintain a healthy amount of margin for doing that business well.
Yeah, I think I guess the one argument is just kind of like the roles change, which is totally fine. I mean, like you said, they still play an important role. You want to go get a mortgage, like it's very reasonable to go to your local community bank. It's just maybe the concept of checking accounts or savings accounts or whatever, where they're just, basically scraping all the interest for themselves. Yeah, it's like probably that role will have to change. But I am curious. So, like, do you view these community banks as being potential issuers of stable coins? Like you were talking about how there's, see a whole lot of that is one, maybe direction, in which case we kind of go back to, I don't know, wildcat banking or something of that sort. Do you see these issuing like their own stable coins? Like if I go to a community bank, would that be a realistic outcome, or is that kind of unlikely?
I think if well regulated, you certainly could have a plethora of stablecoins that have the same high level standard. Right? The problem
Yeah.
is you have different levels of regulation, especially in areas that doesn't have rules that are coming into force. Then you could have quite a bit of deviation in the prices of these potential stablecoins. So it's not out of question, and I don't know whether community banks will do it, but certainly the larger banks, the G-SIBs, are all considering it, right? And that's also why we're building ARC to support not just USDC, but also other stablecoins and other tokenized assets and tokenized deposits. And I think that's quite important to support that sort of ecosystem activity.
Yeah, I think the other thing too about this is that there's almost a UX paradox with building a robust system where on one hand, we really want people, like if using Venmo right now, like I want to send somebody Venmo and I want them to receive dollars, and I want those to be fungible dollars, and they know that there's just one type of dollar that Venmo sends. The same could kind of apply within stablecoins, where you send somebody in the future, instead of using Venmo, we send somebody USDC and they know it's USDC. But on the other hand, like if everybody's issuing with various different like risk profiles in the background, their own stables, that's where it becomes kind of cumbersome, where we want to abstract this from the user. But on the other hand, you may not be getting the same dollars you think you're getting, right? And you have like all these dollars that in your wallet are denominated, just like one line says how many dollars you have, but it may be comprised of all these like various, tranches and like quality of dollars. And I think that's one thing. I don't know if you have any thoughts on that, like with regards to standardizing some kind of like understanding of, I know in the United States, right, with recent regulation, like this is obviously at the forefront, but like that is one thing that does seem, especially talking to, sorry, one last thing is like, especially talking to these projects that help institutions, banks, or even like DeFi protocols issue their own stable. all of a sudden you're talking like a wide breadth of like, okay, this is clearly Goldman Sachs stablecoin is very, very clearly not the same as some, L2 degen stablecoin that's, fronting as effectively $1, right?
Yeah, I think the standardization would come from rules, right? So the Genius Act has still to come into effect. But if anything, if you look at what happened in Europe with MiCA, that's almost like foreshadowing what might happen in the US, which is you do have a large number of banks that want to issue, and some do issue stablecoin that's held to the same level of regulation. And perhaps in that sort of world, you could offer a user the same experience and the same guarantee because you would only be offering, for instance, a MiCA compliant or a Genius compliant stablecoin, or at least people know the distinction of, compliant to whatever jurisdiction's regulation type of stablecoin versus, say, high yield tokenized asset that might or might not be stable, or they don't promise to be stable, right?
Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin.
I wanted to go back. I kind of asked this, but I wanted to maybe see if you could dig a little bit deeper in terms of like the positioning of ARK. So I'll tell you, like I talked to Malesh from Tempo, and they have this massive distribution with Stripe in the background and all these like partners in place. I don't know how much of it's marketing versus like real, but the reality is that Stripe has a ton of partners, right? Like that's undeniable, and they've built like an insanely successful fintech business. That at least to me is like, okay, so that's where they're positioning themselves. Where do you see that? Like, where would you put ARK? USDC obviously is like quite well known. It's been prevalent on Ethereum, but like, where do you see ARK positioning itself right off the rip?
Yeah, I think you brought up a good point. Obviously, Stripe is a large payment provider and player in the space, and of course, their chain is focused on payment as they should. ARK is much broader. We truly see, our Circle's full name, corporate name is Circle Internet Group. Right? We truly see the future of bringing economic activities on chain, and we're starting with financial activities. So ARK will be working on tokenized assets. We'll have tokenized assets. We'll have stablecoins of different sorts, on-chain FX, capital market, lending. Payments will be part of it, but not the only thing. And we're going to push for also adoption of this technology of blockchain and tokenization, distributed ledger, to a wide set of enterprises and institutions. And I think there's a core issue that we're actually solving with blockchain here, which is lowering information cost and lowering information asymmetry specifically. Because in a world in which, compute is getting cheaper and cheaper, intelligence getting better and better with AI, the thing that's lacking, I would argue, is the ability to have coordination, the ability to have almost programmable trust. And that is what a well-designed layer one blockchain and distributed ledger could bring, which is that level of coordination infrastructure for institutions, for enterprises, for individuals. And I think that has far wider implications than just payments or even finance. I think it would fundamentally change the way that perhaps capitalism works, perhaps enterprises are organized, perhaps labor and capital are split, and the boundaries of firms will be blurred because you have more of that coordination over a common infrastructure rather than, you have to trust within a small group of people or a small team, and even within the company with set of rules. I think that's also like the original, kind of the design of some of the chains to have that longer vision. But over time, I think some of the chains have actually lost that vision. So in a way, ARK is having this very ambitious vision of bringing all of economic activities on chain and being the economic OS, because that is so much more, I think it will deliver so much more economic value. And then I'm quite excited.
What is the timeline for ARK?
So we are launching a public testnet this fall, possibly soon. And then we are committed to launch the public mainnet next year sometime, probably next spring sometime.
What kind of applications do you see launching off the rip? And the reason I ask is because obviously us in crypto, we think of Circle as probably, I'm trying to think, probably like one of the most suited up kind of professional of the crypto companies, right? Like it's closer to a fintech platform. Obviously, public company is like very much not the degen side of crypto. With that said, obviously, as you know, like a large portion of crypto is the degen side. What do you think? Like, I don't suspect ARK launches and kind of promotes like Pump.fun, for example. And not saying that condescendingly, but it's just a different market, right? So like, what do you see as the applications? Like, what would bring me to ARK?
Yeah, certainly where it's an open blockchain, so people could deploy their own applications. But we see, well, first, it will come with the full suite of Circle products, which is not just USDC, but also URC, USYC, our tokenized fund, as well as full Circle platform in terms of Mint, Circle Mint, CCTP, which is our interoperability solution for cross-chain transfers, Circle Gateway Protocol, which is also a cross-chain transfer protocol, as well as we are developing an FX engine for powering stablecoin to stablecoin type of FX, and perhaps to be expanded into a number of currencies. So you have the full suite of Circle products, and we see it also as potentially a place for liquidity, being a liquidity hub for stablecoin, because of the ability to very quickly, within a second, to move from ARK to a number of other chains that are supported by Circle's CCTP and Gateway protocol. For that reason, I think it will become first a liquidity hub for stablecoin liquidity, FX engine for on-chain FX, as well as third-party apps, which could range from, of course, traditional DeFi, but also we're hoping to see the emergence of some newer usage that will be deployed.
Yeah, I asked about whether or not stable coins are a winner take all. I'm kind of interested to hear whether you think infrastructure is a winner take all. You're talking about it's interesting, right? You're launching this L1, but you're going to have some like the CCTP. Is this what it's called? Yeah, it's like
CCTP is a cross-chain transfer protocol. Yeah. It's it's not exactly a bridge in the traditional sense, and not a lock and mint bridge.
Yeah, because it doesn't lock it, right? It burns them. Yeah,
exactly.
Yeah, so like this is like a more efficient mechanism, I think, right? I think a lot of people would argue that, but my question is like we were talking about Tempo, we're talking about Google now has something I think coming. Everybody is like launching, and it kind of goes back to this. Okay, well, are we just like fragmenting this again? And like, what are your thoughts on this? Right? Because everybody wants to house finance. Obviously, Ethereum's been trying to do this for a long time. Solana, Hyperliquid now says we want to be the blockchain to house all of finance. Right? Are we just going to have a new fragmentation of all of this stuff? Like,
that's a good question. But nobody has house finance, right? The adoption is still very nascent, and we are aiming to address that growing market, expanding the pie for others as well, right? Because we have that connectivity to fiat, right? Think about moving money on chain. Circle's Mint, essentially for issuance and redemption of USDC and URC, has processed over $1 trillion of gross mint and burn over time. right? That amount of fiat liquidity is only the beginning, and we're bringing a lot more of that. And through cross-chain transfer protocol and gateway protocol, we will move those liquidity and deploy, or users will naturally find it to be an easy way to host their liquidity on Arc and deploy as they like on other chains. Of course, I think there's going to be mining chains still because they fulfill specific niches, right? From specific perp chains to specific payment chains or to specific, I don't know, gaming chains. Those will still exist, but fragmentation, I think, is not necessarily going to be the case if you're going to have, essentially a single slot type of interop between the chains. And that is our goal, to have that sort of fast interop between chains, not only for USDC and URC, but perhaps later on for others, other stablecoins and other tokenized assets as well.
Yeah, I'm wondering not to like put you on the spot, but this seems like a bit of a it's a little bit of a win-win for Circle, because okay, you can launch your own blockchain, and if it goes great. If not, you still have issuance on all these other chains. But I am curious, like, how much in your mind do you spend on making Arc the primary infrastructure layer versus continuing to facilitate? And do you have the kind of breadth of I guess like people and time to continue to do what you do now, obviously, like on Ethereum and all, you still on all these other chains, while also pushing Arc? Or is this going to be something where you're primarily focused on Arc now, and the rest of the stuff can kind of go to the wayside?
Absolutely, we'll continue to be more multi-chain. That has been our thesis all along. We have a very large engineering team. Circle overall is about 1,000 people. I think engineering is not quite half, but it's a pretty sizable fraction of it. So we'll continue to, of course, not only support those chains, but also kind of contribute to them through different means, through commercial constructs, through development. And you can see our continued chain expansion, right? It's actually happening at an even faster pace than before, because I think that is important to support those chains so we can grow with the ecosystem, so that liquidity could be brought to those chains. Oftentimes, what determines the chain's initial bootstrapping and success is the deployment of USDC onto those chains, so that they can get the liquidity from fiat and elsewhere. And we'll continue to do that. And that's not a problem because we have the resources to do so. The Arc side, it's one of the teams, and it's not going to be the only thing in town.
Yeah, I was just thinking, like, with something like Base, you may not see them as competition, but they may see you as competition, right? Like, you guys issue on Base and provide like a lot of liquidity for them, and obviously have a close relationship with Coinbase. So I think in some ways, I don't know, it is kind of interesting, right? Like, because it does seem like everybody ultimately wants to kind of at least be able to control one part of their infrastructure layer. And I don't know, it's just
we'll see how that play out, right? I think different chains do end up with different niches for one reason or another. Sometimes planned, sometimes unplanned. Right? You do see pretty specific type of activities on some of the chains, and we'll see how that evolves over time.
Okay, last thing, shifting topics a bit. Given your experience as a trader, and I'm hoping this comes out in a timely fashion, but we'll talk about it anyways. Last Friday, there was basically a market nuke. It was pretty drastic it was like quite drastic, even by crypto standards. Like, just give me your overarching thoughts, right? Like, having come from TradFi, having seen how it actually works, and then now seeing how, quickly we can get decimated.
Yeah, we've been touting the fact that blockchains are, super efficient, and also everything is final, right? And everything's automatic and atomic. The events last week did raise this issue in my mind of, do we actually need a circuit breaker? Are there elements of TradFi that that we should consider? Of course, there are many that we consider throughout, and we have slowly adopted to. But this concept of circuit breaker does come top of mind. I actually, part of my PhD dissertation, which was a long time ago, one of the chapters was on slow-moving capital effects, which is this concept of Sometimes there's liquidity that exists in large pockets. Perhaps this is the end user type of insurance companies or asset managers, but those liquidity cannot be brought online really quickly. And that's essentially what sometimes the circuit breaker does, right? It pauses everything, make everyone think about their positioning, and then those slower moving capital could actually fill the void. And some of the slower moving capital, for instance, actually takes quite a bit of time. Right? When I was at Harvard Management, sometimes it takes a quarter of board discussions for capital to move into that. We can't pause the market for that long. But I do wonder, are there ways to introduce some new mechanism in DeFi that would allow us to think about, essentially how do you stop this wheel from spinning in a downward spiral? Because it was quite scary. And if you think about, great, we've been marketing the success of DeFi. We're going to tokenize the world's assets. Think about what would happen if, say, a tokenized version of S&P 500, along with all the other stock indices and stocks, trade the same way as the crypto market did last Friday, which some of the altcoin, I think, had like 80-90% drawdown within an hour. That simply cannot function in TradFi, right?
Yeah, but a lot of these, like, I guess and this isn't so much a counter argument as it is just an observation. And frankly, like, a lot of people have talked about this for quite some time, which is that you look at CoinGecko or CoinMarketCap, and like you look at FDV and you look at, circulating supply, and you can go and look at volume, right? And then the reality is that like the actual liquidity for the overwhelming majority of coins is like some very, very small fraction of that. And like, this is something that crypto seems to have to learn over and over, which is like, you think you have some amount of like supply and demand in the market. And in reality, like what happens, they just pull it. They just pull it. And like a lot of these things are worth zero. So there's really nobody to step in. So I guess that's the only point. Like it's when you talk about like these altcoins going in like negative 90%, I'm sitting here, I'm like, well, I don't know, maybe they kind of deserve it. But I do understand your overarching point, right? Because like you don't want to see some flash crash on Bitcoin for similar reasons, right? Like, so I understand what you're getting at.
Yeah, but maybe this is why exactly we need better development of AMMs and liquidity providers as not just specialized technical institutions, right? Like for a long time, crypto people thought, oh, central limit order book must be the way because that's how TradFi does it. It must be the right way. But actually, that's not true. Whenever you want to execute a very large trade, you do a block trade. You pick up the phone and literally call a broker-dealer. You don't go to a central limit order book. I think we're discovering that. And we're also, I think we do need to figure out better mechanism on AMM liquidity provision, but also on perps, right? To figure out how do you deal with auto-deleveraging in a way that's not so harmful.
Yeah, what did you think about like the auto-deleveraging thing?
That was a surprise. I actually, never really knew about the mechanics of auto-deleveraging until that happened, right? It definitely gave me a pause of, okay, well, if that's the limitation, if you're building something that's synthetic that has exposures to perps, you had to have extra agreements in place to make sure you don't get auto-deleveraged. But even that might not be possible because it is a zero-sum market. So I think it's a hard thing to build around. And I think we had to come up with either better mechanisms or perhaps the need for better standards, maybe an insurance fund and etc. For it to work properly.
Yeah, I agree. I think the only other point about this, which has been brought up now by a lot of people, is that crypto is so fragmented and it is hard to defragment this, right? Like it is hard to unify this. We have the New York Stock Exchange, there's circuit breakers on that. You can't ask, well, you could, I don't know if it would work, but you can't ask Binance and Hyperliquid and all these other dexes to all agree to some structure. They're all trying to win house finance, right? So that's the other issue, right? Is like when there's some massive price discrepancy on these two, exchanges, well, right there, that's cause for market makers and people engaging with these markets to pause and be like, hang on, like what's going on here? So I think that's another thing too, is like, it is so fragmented. And I don't know exactly what a solution to that would be.
Yep. It's an open design space. I think you have to think that there needs to be at least a large number of like larger exchanges to agree, it's both centralized and decentralized, pause in certain circumstances. I don't know what the limit is. Maybe like market's down 50% or something. But if you don't have that in place, yeah, of course, like you don't want to be the one that pauses when everybody else keep trading.
Yeah, I want to ask you actually something else since you have a background in trading and TradFi. Just regarding perps in general, I think that perps clearly have a product market fit with retail, and I haven't really traded options, but I do think that perps are very intuitive for the average retail participant. Now, like whether or not they should be engaging, that's a different question. But like the fact of the matter is it's quite easy to understand. Okay, like you can create one synthetic position and lever it up and it's all right there. And like when your money's gone and you can close it whenever. So for my point is like for retail, I do agree. Like this seems like a great product, but from your experience with TradFi and hedge funds, do you think that a large hedge fund would want to open a perp position? Obviously, like they have to deal with funding and stuff. It's a bit different than options contracts. Like, how do you think this is a valuable unlock for large institutions, not HFT people or not like traders who are, taking not like toxic flow or, whatever. I'm talking about like, would a hedge fund put on a three-month position, 2x or 3x levered, with a perp?
Yeah. So that's a great question. I think at the end of the day, markets needs to serve a function beyond simple speculation. It needs to serve an economic function. So the derivative market in a TradFi space, whether it's options or futures or forwards, are oftentimes used for hedging purposes.
Right.
So FX market, the bulk of the volume is FX forwards and swaps because they're hedging cash flow of either bonds or real cash flow of like trade, right? And those hedging creates the perhaps demand premium that allow other hedge funds to trade or other market participants to essentially provide liquidity and trade. If you just have perhaps hedge funds trading against each other in a perp, that's a zero-sum market. I don't think that would kind of exist in a large volume, other than maybe just hedge fund taking advantage of retail, which isn't a great market structure either. And eventually, retail would lose so much that it wouldn't make sense. So I do think, perp is great as an innovation. I do think there also needs to be like products that are designed for hedging, perhaps have maturity dates that align with cash flow or align with something else. But it should be used for the end users to kind of insure away the risk rather than just one speculator against another, however large they are.
Going back to the auto-deleveraging thing, there were some people who were, well, at least like crypto Twitter people, so I don't know like the degree of sophistication, but there were some people who had like very large positions and who had a lot of money and ran into like some ADL or other problems, right? Like even trying to get liquidity on chain and stuff. It seems like this is not something that a hedge fund moving real money would ever want to deal with, like not knowing, right? Like, are there other things right now that are like massive, sort of, problems that large actors really can't engage with these markets for certain reasons? Like they don't understand how these work necessarily, don't understand what the exchange is going to do. Even like this Athena thing, right? Like they had some deals in place where, they were lower on the queue or they weren't auto-deleveraged at all. Like, do you think that real actors are going to want to engage in these markets? And I'm asking you this from kind of coming from TradFi background.
Yeah, I mean, real actors won't engage in markets unless they are like also well regulated, right? So you have to understand exactly the mechanism, but you also, if you're a true institutional player, as I mentioned earlier, even with banks and broker dealers, they can't really do too much of these activities because it's capital inefficient. So that's one barrier, but I think it's also just, it goes back to like the use case, right? They want to understand the flow where the persistent alpha will come from. Is it just coming from retail speculation or is it coming from something else? And I think that's also kind of a necessary piece of institutional engagement because it costs a lot for them to actually decide to invest all the resources and human capital and trading system for like, a new thing, a perp or something, right? Can they make sure that market continue. My bet is like, perp market is probably not going to be as hot as spot market, for a little bit, because people realize, well, this thing could actually blow up in people's faces, and there's at least right now no good solution to the auto-deleveraging issue.
Yeah, I think also, I mean, I do take your point about what happened like last Friday, and you saw like these wicks 80 or 90%, but we do have to think. I mean, a lot of these people were just like extremely levered.
Oh yeah,
up. Yeah. So it's like
it's like people who bet on Nasdaq during the .com bubble, right? Like, yes, there was a market crash, but it didn't have a real economic impact because the difference is like there's no debt, right? This is like kind of going back to that narrow banking thing, right? If you don't have debt that's created an economy that has a perception of stability, then you don't have a widespread issue. But if the debt instrument actually breaks down, you have a much bigger issue. If it's just volatile, people it's just speculators losing money, it's an issue, but it's not like an economic important issue. So this kind of goes back to perhaps like some of the seemingly stable debt instruments. That I think that will be like the potential issue.
This has been fantastic. I think we covered a whole bunch of topics, so I do appreciate you coming on.
Thank you so much. It's a pleasure.